The broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Chris. Welcome to our monthly Connect Series webinar. Today's August the 2nd. I hope your summer's going well, and hard to believe that kids are going to be heading back to school pretty quickly. Let's go ahead and get started here today. As a reminder, we're not a bull or a bear shop. I believe being bullish or bearish is nothing more than a psychological state of mind, and we try to use the power of the pattern to help us get through and provide opportunities. We like to say that we have the 28-second solution, that we recognize that all of you are very busy in your lives. I know some of you receive lots of different information besides ours, and not a darn thing wrong with that. But some people look at research reports that are 7, 10, 30 pages long to finally come up with a conclusion or buy or sell. And as you know, as being members, we're trying to make your life just a tad bit more efficient. All of us have a few things in common: death, taxes, and we trade price. So that's why we try to share price ideas with you constantly. Well, so let's get started and look at the major stock indices. And from the 30,000 foot view, this is our update on our Fibonacci retracement levels. Again, I feel like these are very important charts from the aspect that the 2007 high and 2009 low on the Dow and the S&P are what we are applying these Fibonacci levels to. You'll notice that for both indices, we are able to apply the Fibonacci levels to the same time frames. They both ran up to the 161 level and spent, you could go back to here almost a year and a half, just pushing up against there, broke above it, used old resistance as new support, and took off. That's a pretty ideal circumstance, and you can see they've really pushed, higher ever since that time period. I don't try to spend gobs of time, going over it, but just as a reminder, the next Fibonacci extension level, based upon the 2007 highs and 9 lows, for the Dow is 25,000, and for the S&P is 3,000. A little closer look on the S&P, where we took the weekly closing lows of 2016 and the highs later in the year and applied Fibonacci, and you'll notice that the 238 level came into play. Market ran up against here, backed off, punched through, tried to see if this support would hold. You can see a fairly large potential bearish wick. They tried to sell it off and brought it back, and then it was back off to the races again. So as we speak on Wednesday, August the 2nd, we're very, very close to all-time highs. This is a long-term picture of the Nasdaq 100. The Nasdaq has been stronger than the large caps since 2009. This is a look to share with you the very clean rising channel in the Nasdaq since 2011. It stayed inside channel 1, continued to test the tops a few times in 2015 and the bottoms in 16. It did, we saw a little bit of weakness a few weeks ago, and we saw it come back down and test dual support, and then we've seen the Nasdaq rally off of dual support, which is a positive with the trend being up. We did see a little bit of a bearish reversal wick. You can see that little tiny slice right here, which was last week. This is a weekly chart. So this is not where you would want to see any type of reversals, up here when we're testing old highs. Doesn't mean that it's bearish, but that's not the kind of reversal patterns that you want to see a lot of. So far, that doesn't mean that much to the broad market, but it is amazing to me to see, like today, Apple doing so well, and I think Amazon as well, and the Nasdaq was actually a little bit flat, on the day. So there's just a few things that are holding up some of these indices that I think we have to just kind of be aware of. This is a look at the AD line from a big picture perspective. This is the common stock only on the NYSE based upon a weekly basis. It just remains in a really solid trend. One of the things that you want to look for is it moving up, which it is, which is historically bullish. One thing that you'd want to look for on the flip side to be concerned of is if it would be diverging against the market. In other words, if this line started heading south and the broad market was still going up, that would be a negative divergence, and that would kind of raise a short-term caution idea, but that is not happening at this time. You can see a strong AD line continues to take place. Pretty impressive. This is a look at junk bonds, looking for other pieces in the puzzle to see how they're doing. Junk, you want to see it heading up if you're long or bullish. And junk has been heading up since the 2016 lows right here, where you see that it tested support. And now you see that it's testing overhead resistance. This has a chance to be a bullish ascending triangle. Regardless of that pattern, you can see that this blue line at the 37.41 level has been some resistance, 37.33 level, and it's just testing right at it, while momentum is being tested as well, a series of falling highs. So positive message still from junk at this time. Bulls would like to see it break out. Bears would get concerned if you would see a reversal and heading south. This is just kind of a real quick snapshot. This is not the global dashboard. This is another dashboard of just all stock indices. The top 6 that we're looking at are all in the United States. We have the S&P in the upper left, Dow in the middle, Nasdaq in the upper right. You can see since 2009, they all remain in solid rising channels. We have small caps on the left, mid caps in the middle, and the value line geometric. Again, you're seeing similar looks, all inside long-term rising channels. The only concerning chart patterns here that we will address later in the seminar, or the webinar, excuse me, is this is the DAX on the left. This is France, CAC 40, and London in the lower right. And we'll dig in and look at the DAX and CAC France just a little bit closer, seeing a little bit of unimpressive action, not bearish by any stretch, but just a couple of things taking place that I think I want you to keep a real close eye on. I know that we will be for you. As a reminder, we just finished the month of July. This chart's from a good friend, Ryan Dietrich. This chart discussed the average or typical pattern in July, that there's 2 things that stuck out to me here, that it typically peaked, had a good month typically. It typically peaked around the 3rd week in July, with the average gain being about 1.8%. So how did we finish up the month? This is a look at several of the main indices, but the thing that jumps out to me is the average July was 1.8%, and you can see the S&P up here came in on the month at 1.66%. So pretty much in line with historical norms. You can see with tech led the way over the last 30 days, with mid and small caps being the laggers for the last month. And you kind of see right in here, once the Nasdaq took a little bit of a hit, you can see it was up 6%. It gave up almost 200 basis points during this time frame, and then it's been flat. But you can see with the Dow and the S&P have continued to move up towards the end of the month, with weakness in mid caps and small caps. So pretty much an average month performance-wise, kind of what would have been expected, pretty much came to be. So let's moving on to August. Ryan updated some charts for us that I wanted to share. So this is the typical August for the last 10 years on top, and the typical August for the last 20 years on the bottom. But you can see overall that you see similarities, that they typically have started out the month at the high, worked themselves lower over time. So the average performance over the last 10 years has been almost a negative 80 basis points, with the performance over the last 20 years being negative 1.3. So it doesn't mean this is going to happen, but just want to make you aware that typically August is a soft month. Nothing terrible, but typically soft. So another piece from Ryan that I wanted to update. This is each month broken down with the average return for the month and the percent higher. So if you're looking for bullish, you want to look for the green shade. If you're looking for red, you can see where most of the reds come in. So just kind of wanted to update that August and September back to back are the 2 worst months from 1980 to 2016. That's when I got into the business, in 1980. I know that sounds like a long time ago, and it is. But anyway, these are your typical softer months. So doesn't mean the market's going to go down. I haven't given up on long positions. You can see we'll look at our positions sheet later, but you can see we have a lot of long positions. We're fully invested. So just because this is here doesn't mean to give up on those, but I want you to be fully aware of the typical or historical pattern in the month of August in September is soft. Because of that softness, I'm going to pull up, you saw last week, as we were getting close to August the 1st, I did it on Friday, as close to a weekend as we could, where I pulled up the stops on many of our positions due to the seasonal patterns. Did sell what's the mid caps, let go under some of the exposure on IBB last week, but for the majority of our positions, pulled up stops tight because of the seasonal pattern that we see. So if some of the seasonality would take place, or regardless of seasonality, if this market would all of a sudden start giving back gains and heading south, these tight stops could take the positions that I have in the stock market, or the stock positions themselves. Wouldn't have anything to do with coffee or some of that, but we could really see a lot of those positions reduced rather dramatically and quickly if this market would head south. So remaining long, just pulled up the stops a lot tighter than normal. So one of the things that I sent to you premium members today is an idea on an ETF that's probably the worst piece of in the ETF world, and it's VXX, and it's the fear ETF. And you can see in the lower left, it's split adjusted. They just keep trying to split adjust because it's done so poorly. The bottom line is, from roughly 2009, the split adjusted used to be 35,000 a share, and now it's 11. The majority of the time, the only thing this ETF's good for is to not own it or be short. But on the right side is a blow up of the chart on the left side. These are both the same charts, but in the lower right side, we see that this ETF continues to decline. You can see since there was a little bit of fear in May, the ETF got up to $16, and then all of a sudden now in August it's down to 11. So that's over a 30% haircut, losing over a third of its value in a short period of time. Obviously it's in a downtrend, but if VXX would start to head up, in my system I've set buy alerts that if we break above falling resistance and this horizontal resistance, the dual breakout here, I will be looking to buy this piece of won't be big, and I'm not doing it as a hedge. I've already received a few emails. I said don't read into this, and a few of you it's all fun, but a few of you have, started talking about shorting stocks and things being bearish, and that's not the case, folks. This is just an ETF that's been crushed. Volatility's compressed. We've seen a few times where volatility has shot up huge on just minuscule 2, 3, and 4% declines in the S&P. So something like that could happen in the historical next 60 days. So if something like that would, most likely the XX would head up, and I'd be an owner of this. But again, this is probably the only good thing to do with this typically is to short it. Obviously, you can make a lot of money if that trend would continue. So, but I want to make you aware that I do have this on the potential list of ETFs to buy if we get some positive price action in VXX. Just as a reminder, I'll send separate charts, on these. We're into the month of August. Here is the stocks of the S&P 500, the top 20 over the last 10 years in the month of August, performance-wise. And you can see that the average return, for in the upper left is -60 from our calculations, +70 on a median return. But we're going to start looking. I'll share some of these chart patterns in this upper echelon to see if we've got some things going well. Ironically, Apple, its average or median August performance was 4%, and it almost has got the whole month accomplished by August the 2nd in the earnings report that just came out yesterday. So again, we'll share the charts and keep you updated on this list, but I wanted you to just make sure that you are aware of the top 20 stocks. So I shared earlier that the only of the global dashboard of stock indices, the only ones I was really had any concerns about, and not bearish concerns, but just watching some weakness in prices, was the DAX, Germany and France. So these are the same charts, both sides. This is a long-term view. You can see this it remains inside this trend, so it's still obviously a bullish trend. This is the 2015 highs. You can see the rally that we've had this last year broke above it, and now it's come back below it. So here's a much closer look on the right side, and then we put a rising support line off this about a year ago, a little bit more than that. You see these rising lows, and so The DAX is now back below, just by a small fraction of what, 1% roughly, below the 2015 highs. There's a gap right in here that it looks like it could be filling. If it would turn around and head higher here, that'd be a really positive sign that had a gap fill on a weekly basis, could push higher. But I'm going to watch it really close here on this rising support as we're entering this 60-day window of historical or typical softness. So on the flip side, or not the flip side, but just another European index that has a similar look to it, this is France. And so this is also the 2015 high. You can see the strong rally that's taken place, pushed above it, and now guess what? It's backing off back below the 2015 highs. And on the right side, you can see here, it's actually a fraction below this rising support line. So I do believe that these indices are important. We own EFA, so it's important to that position in Europe, but also just what these do can have an influence on the broader markets, in the States. So to see the long positions to continue to do well, we would not want to see the DAX and France break below the rising support. Another chart that this is an update. Thank you, Todd B, for reminding me to share this. It's a chart to where this is the Dow transports. Typically would have been easy for anybody, including myself, to get faked out at a couple time frames, but I want to go through it. This was in 1998. And so you see that the transports made a high, then dipped down hard, and then came back up. And once if we draw a horizontal line that I don't have in here, if you draw a horizontal line, it would have been easy for anyone, including myself, to say, aha, we got a breakout. Wow, we recovered from this dip. This was the Russian debt debacle. A lot of people want to point a finger to that in the late 90s, regardless of what the so-called excuse or reason is. It dipped and then came back. But then once it broke support, all of a sudden that decline didn't look as big as what was to follow for several years. The thing that's intriguing from a power of the pattern perspective, I just took these highs and created this line, everyone, and I did something really fancy. I just copied and pasted it. So I took that line and I laid it on this high. And lo and behold, look what happened again in 2008. So if you had drawn a horizontal line, you'd feel like, oh, we got a breakout in hand. But all it was a fake out. When support was broke, we saw this large decline again. Both times it declined 50%. So am I saying we're going to have a 50% decline? The answer is, I have no idea, and I'm not suggesting that. The thing I'm just saying is this is right now a low odds pattern. I think in time this could blow up and just be a mute. Well, that was interesting for a while, but if this is something that ends up being a correct read, this puppy could be really important. So again, I did something really fancy. I took this line and I copy pasted and I laid it on this high in 2014, and lo and behold, what do you have? The market recently ran up and hit that resistance line, and it's backed off some. So at this point in time, August 1st, nothing proven, but other than these patterns have somewhat of a look-alike. Again, I've shared it in the newsletters. This doesn't matter until it matters. It's a low odds of being accurate, a high impact if it happens to be. So we're going to keep updating you on this chart pattern as we go along. And I think I got another chart later on in here on just an update, a real up close of IYT, the transports ETF. So, since we had a new president come in, there's been a lot of talk about reflation. Now the reflation's not happening, and maybe it is happening. So just a little bit of an update on a few indicators. The top line is copper divided by gold, which has been a pretty good indicator over time, everyone, indicative of inflation or lack thereof, or deflation or disinflation over time. But you can see, and then the bottom red line is the yields on the 10-year note. And we all know that as bonds get concerned about growth, yields oftentimes rise. And when they aren't concerned about it, yields fall and bond prices rally. So prior to the election, prior to the quote-unquote reflation theme becoming popular, both of these started heading higher months before the election. And then you can see they actually peaked out prior to the inauguration of the new president. So then we've seen a series of lower highs. But as I saw these dipping and coming down into these levels, seeing some of these, and in the next chart, we'll look at our inflation indicator, which is TIP divided by TLT. Start to see a little bit of bottoming and some rally up. This is one of the pieces or tools that I used to feel some confidence to go buy Freeport McMoran. And we all know that that's been a really good trade for us over the last 70 days. But this is how we can use these type of tools to help us look at taking other positions. So we've got a big test on the copper gold right now because it's testing the highs of late this last year. Obviously, a breakout here would reflect copper stronger than gold. Freeport could continue to go well, and some of the other basic material plays could as well. So the top one is especially intriguing to me, being a test of these prior highs. This is the TIP TLT chart that I just mentioned. You'll notice it started heading up prior to the election, but from a 30,000 foot view, this puppy is still in a long-term downtrend. The pink shaded falling channel continues to create series of lower highs. I believe this is around the March timeframe where it hit falling resistance and then turned around on a dime and has declined. Right in here when this support was being tested, also when FCX was purchased. And then we've seen now a counter trend rally taking place with a small attempt to break falling resistance here at 3. So long term, obviously the inflation indicator is falling, but we've seen a little bit of a rally. And again, this is how I try to use something like this to position ourselves, like in the copper arena, the Freeport, and also to make some decisions on bonds in general. So speaking of bonds and interest rates, this is a reminder of the long-term chart going back about 25 years on the yield on the 10-year note. The one piece that we've talked about, I'm just going to bring it up again. This is a highlight of this blue shaded area, and this is when rates were just really ramping up starting last July, July of 16. They were ramping up sharply. There was this unfilled gap. So this was just kind of the initial chart that we shared in two months ago in the Connect series. And now here's an update on that chart. You'll see that here was the unfilled gap. It ran right up and hit the long-term 25-year falling channel, double top, and yields have backed off. They filled that gap. Once they did, we saw a sharp rally, which caused us to give back some gains that we had in TLT. But for the most part, you can see choppy action is taking place now inside with the resistance here and support at the green line, down here for yields. So still in the long-term downtrend, obviously still a downtrend over the last 6 to 8 months with a little bit of rally here of late inside a counter trend rally inside the long-term downtrend. This is an update on TLT. It hit rising support back here several months ago at 1 after this huge decline, potential double bottom. It bottomed right along here. We had this rally, and then that's where the gap was filled. Then you'll see that TLT has backed off, and so here's the trading range that TLT is in. Our stop on the long TLT position is just below this green line here. So I remain long, but if this would break, I really don't want to ride it potentially from the 122 level, down to 118. I really don't want to give up 400 or 500 basis points there. So would be stopped out. As a reminder on TLT's seasonality, 'tis the season historically to be long bonds. This is a look from a Sentiment Trader, and you can see right here we are at the 1st of August that historically, if you think about this, it makes a lot of sense. If stocks historically are soft, if you have the teeter-totter effect, stocks are soft historically, what do bonds do? It shouldn't be a surprise if that relationship would keep in line that the average gain for TLT in the month of August is almost 3.5%, and then another strong month in September historically. And so to me, that would make sense. So we'll see if we get stock weakness. But I just own TLT and the AGG positions, which was purchased late last year because of the patterns, not seasonality, but I just kind of wanted to let you know what the seasonality looked like on TLT. As far as where does sentiment stand on TLT right now, you can see in the arrow on the right side of the chart, it's close to just mid-range. It's not an extreme, close to the 80 level that we saw recently, and it's also not an extreme where it got down to 20 also recently, because we've seen some pretty sharp changes just in the last 30, 45 days. But mid-range right now, so no extreme on either side towards sentiment, towards bonds, even though we are entering this historically positive seasonal time of the year. I wanted to update you on the look of the stocks versus bonds. This is SPY divided by ZROZ, which is the long-term zero coupon bond ETF. So if you happen to be blessed and be right on picking interest rates, if they were going to fall and bonds were rallying and you were aggressive, a ZROZ would be your play because it has even a higher standard deviation than TLT. But you can see that back in March, when the reflation theme kind of was peaking out, bonds were doing poorly and stocks well. You can see potential of a double top. You can see that the decline in the ratio then hits support, and then we've had this rally. So for the majority of the time since late last year, this ratio has been in a choppy pattern in a somewhat subdued range. But typically, I guess, excuse me for saying typically, the bottom line is this ratio is very closer to the highs than the lows when you look back over the last 7 to 8 years. Just we'll quickly go through valuations. This is, as most of you know, I was a student and of Sir John Templeton for many years. Sir John was definitely thought of as one of the greatest fundamental valuation investors in history. A lot of people didn't understand, didn't know him well enough, and I'm not saying that I knew everything about him because I didn't, but one of the things that he didn't really get credit for that I believe he deserves is the understanding of just human behavior and psychology. He was just really great at picking these long-term trends. And so, in the late 90s, Sir John shared, hey, Chris, there's numerous reasons that I don't think the market's going to make much net gain for at least 15 years. We went through a series of things, and most of them were valuations, folks. So in respect to Sir John, and I can't get it out of my system, this does not mean to be bullish or bearish, but let's just kind of take a look. This is from Doug Short at dshort.com. 4 different valuation measurements going back 125 years. And you can see where the market peaked in 1929. Valuations were high in 66. Here's 2000. Here's 2007. So we're much closer to historical highs than lows. This does not mean that current trends whatsoever have to stop, but we do have to realize that, not that any of you are, but from a buy and hold perspective, or if you're a slow money trader, you do want to, I think, have this perspective is that, again, this doesn't mean the trend has to stop, but if you were to put a new $1 into the market, try to invest in the long term, the odds are pretty low that you're going to make a lot of money with that new $1, because so far in history, no long-term bull market has ever gotten started and continued to really expand from current valuation levels. Another look at the Buffett indicator, which is corporate equities divided by GDP, reflects in the upper right that other than these highs in 2000, this is going back, it's a 67-year chart, we're much closer to highs than lows. The Shiller CAPE ratio, you can see, thank you, Charlie, below on this chart. Right here is where we are at current levels. Here was 1929, 1966, 2007, and the year 2000. You can see historically that the CAPE ratio is much closer to highs than lows, and this is typically not where new long-term bull markets get started. Another thing that caught my attention from Charlie was this, is that the S&P has been doing well, and this is it's a look at monthly up streaks since 1928, and so far, the S&P has had 9 months in a row to the upside. Obviously, there's a lot of months that you can go back and look at this. So only twice was there a year you can see that was up without a downturn, twice 11 and twice 10. So we're definitely in the longer streaks that oftentimes are going to come to an end. So doesn't mean it has to end here whatsoever, but just from an elongated perspective, I wanted to kind of share with you this unique statistic. Another piece, this is from Dana Lyons. Thank you, Dana, for sharing this. This is the value line geometric composite overlaid with so you've got a real broad index on the top and the American Association of Individuals cash allocations. And you can see that the average investor has the least amount of cash or powder to invest in the market since January of 2000. Again, this isn't bearish, this is just perspective of fuel for further rallies. That with the average investor right now, fuel sources are historically low, typically closer, that would suggest the market is closer to a short-term high than a low. This is the CNN fear greed indicator, just kind of give you some perspectives. You can see in the upper right that it's pretty lofty right now. Again, doesn't mean the market has to do anything, go down along that line, but historically this indicator is reflecting a decent amount of greed at this time. Not too many times over the last 3 years has the indicator been higher than it is right now. So moving on to metals, I wanted to share this. This is the gold-silver ratio. Typically, if you're long metals, you want to see the ratio heading south or down, which would mean that silver is stronger than gold. You can see when this ratio was really falling from 2009 to 11, that's when gold and silver just really rocketed higher. So the thing that has my attention, this is where the bear market in metals started from 2011. You can see that gold was much stronger than silver, and there's a possibility, this last year in 2016, that it could have double topped. And while it's up there, it could be making a long-term topping pattern. So keeping my close eye on this, and we'll continue to share this, that if this ratio would break down at 3, historically that would be positive for both gold and silver, and typically the miners. So this pattern is a long way from being proven, but you can see that for a couple of years it's traded sideways, which when you look back, there's not too many time periods that it traded in this narrow of a range for a couple of years. So it could be interesting how this thing resolves itself. But if you are long the metals, you would love to see this support break here, which would reflect that gold is weaker than silver. From a long-term perspective, this is the dollar versus gold. And when this ratio is going down, the dollar is weaker than gold. That's typically positive for the metals space. This is where the bear market in metals started. In other words, the dollar was stronger than gold. So we've got a little bit of some potential positive news for metals bulls, that you can see that this 6-year support line this week is making an attempt to break support. And I think the big key, that's a positive sign. You don't really see the metals responding a lot to this. This may be, I don't know that it matters, but it could be potentially that the dollar is just weaker than metals versus metals participating in a rally at this time. But the bottom line to me, and from a power of the patterns perspective, if this ratio would head south and then break this support line, you could probably bet that the metals are going to be doing well. And so we have taken a position, as you know, aggressively in GDXJ. We'll see how this works out, but wanted to update you on the dollar versus gold. And then we'll look at the flip side. This is gold versus the dollar. So this is the way you would kind of want to look at this from a bullish bearish perspective, that we're seeing for the first time. You can see right here in this is a weekly chart, the last couple of weeks, the ratio is attempting to break out of triple resistance here, which is historically a positive for metals. Again, we don't see a lot of positive action taking place there, but this historically is a positive move. The biggest thing to me would be, is can it get above last summer's highs? Because when that peaked out, that's when the metals and the miners really got thumped for quite a while, for several months. So we're not quite there yet, but if we'd see this ratio break, above here, it could really be a positive sign for the metals space. So we'll just see how it goes. Here's a look at copper. Copper itself has had a series of lower highs along line 1. This is a weekly chart, so a couple of weeks ago we saw a small push above that, And then this was last week where we saw a big push in copper and also a bigger push in Freeport. That did take that up to the 2015 highs, where we saw a little bit of selling pressure last week at the end of this pattern. We saw copper try to push higher, and so far this week, just a little bit of softness there, but it is pushing up against 2015 highs. If it would break above that, obviously that'd send a really positive message in regards to copper, and I would think Freeport McMoran as well. One of the things, when I started seeing positive things back in May, a couple of months ago, it'll be 3 months ago here in 2 more weeks. It's been, 10 weeks roughly ago that we bought Freeport. It's always, I make a decision that from a positioning perspective, that if we're right, I like the idea of copper then, but if I just wanted to just take so much money, invest it in one sector, I chose this sector that I liked what was happening in the reflation trade in a short-term perspective, and I didn't buy copper, but I liked Freeport McMoran. That was my play for this sector. And so this is just a look back since the purchase of Freeport. As of today, Freeport's on the remaining shares that we have still up 24%. Copper's had a nice rally of 12, but you can see we really got paid for owning the position in Freeport, that it's 100%. It's a double or a 12% greater gain. But during that time frame, not all of the metal space participated. Gold's had a 1.3% rally in 2.5 months. Silver essentially flat, and GDX is as well. So we've gotten lucky and blessed. I'll take both of those anytime. But Freeport's paid off, for us really well. But this is what I typically do: is when we're looking at some of these things, I just want to weigh out if I'm going to be long. I want to be long the place that could give us the most bang for our buck. As a reminder, this is the silver gold ratio over the last 32 years. What you want to see is when this ratio is going up, that means silver is stronger than gold, and typically both are doing well. The point in this chart is the trend still remains down. You can see this decline has taken place. But the bottom line is this ratio is much closer to lows over the last 30, or let's just go back, to the 90s, so we could say roughly 20 to 25 years. This ratio is getting much closer to the lows than a high. So just because it's low doesn't mean that these things are going to turn around, because they're solidly in a downtrend. But this is where some really nice rallies have taken place. And that means that gold and silver both did well, and the miners during these time frames. So it's really interesting that we're back down to some levels that are very deeply oversold, seldom seen. Typically means that metals are closer to a low than a high. Now, we can't overlook this time period here. You can see in the 90s, that puppy went much, much lower than it is now. So does it mean that this ratio has to bottom now? The answer is absolutely no. But over the last 25 years, it's closer to a low by far than a high. Looking at the important crude oil market just real quickly. This is looking back over the last 10 years. This falling resistance line, it comes in as resistance at this time. We can see the big decline here, a counter trend rally into 2015, and then a lower low. We've seen this counter trend rally. Late last year, early this year, it ran back into resistance again at 2. You can see several times it's tried to poke above there, and then we've seen a series since essentially Thanksgiving, a series of lower highs on this weekly chart. Each of these pink lines were placed upon weekly closing lows, just to show you that the continued series of lower highs. This is coming into play about $50, 52, right in that range, this resistance. But this week, another lower high test is taking place just below $50 here at 3. So obviously the crude market is important around the world, and energy stocks, they've lagged. We're going to look at a couple of those, the energy sector just a little bit later on. But still at this time frame, 800-pound gorilla still is above crude oil. And one of the things that, as it's pushing against resistance, I want to bring up this chart. This is a position of traders. So you can see your hedgers, back in 2014. When you look at the top chart, which is crude oil, you can see it was really in a narrow range for several years. But while that was taking place, the crude traders just kept getting more crowded and more bullish and more crowded in the bullish, and until they'd amassed the most crowded position in history in the oil market. And then when support broke, they were in trouble. And so we were above 100 down to in the 30s or $30 range. So big hit. Then you see the traders reverse that. But with all of that said, I just want to kind of share with you again, from a long-term perspective, this still remains a fairly crowded trade with a lot of people betting that crude's going to go higher. And not that they can't be right, but the last time that this large of a trade was taking place to the long side, the longs got spanked pretty hard. So we want to keep an eye on that. And this is as crude is up against that long-term resistance line. So even with all of that said, I remain, as we said, we're not bulls or bears. We're just trying to take a look at chart patterns. This is the chart pattern on the energy ETF XLE on a weekly basis. You can see since 2014, it got really hit when oil did. We see this counter trend rally. Then since, just call it the first of the year, Thanksgiving to Christmas, right in here, XLE peaked, a continued series of lower highs inside this pink channel. And then we've seen 1, 2, 3, 4, in the last 5 weeks, a small counter trend rally to take it up against overhead resistance in the top of this falling channel. You can see in the top, momentum is deeply oversold and starting to turn up. So I remain completely open-minded that if we'd see XLE breakout here, I would look to be a buyer. Obviously, this is one of the harder hit sectors. You can see if this was around 80 a share and we're now down to 66, it's been a pretty good haircut over the last 8 months. So not too many people like this area as far as energy stocks themselves. So if we see a breakout, I'll be looking to take a small long position at a minimum. So just lastly in this, the energy area, this is the Thomson Reuters equal weighted commodity index going back to when I got in the business in 1980. And as you can see, these two sharp rising blue channel lines since 1986, now for 30 years, this index has remained the majority of the time inside this rising channel. This was the lows last year that took place in the beginning of 2016. The commodity index hit this. This is when crude was screaming lower. Stocks were also struggling. And as this indice created, this is a monthly chart, this large bullish wick at this 30-year support, it started turning higher. We saw the stock market turn higher and crude turn higher as well. We saw this counter trend rally hit the 23% fib retracement. That's the 23% retracement of the big move from the 2011 highs to the 16 lows, kind of double topped here and then backed off. So this is a monthly chart. So 3 months ago, the index came back down and tested this 30-year rising support again and created a really large, on a monthly basis, reversal wick similar to here. So that has a positive twist to it, there's no doubt. So we see overhead resistance coming down with rising support. So I just wanted to kind of highlight this blue shaded area. We've got a pennant pattern going on in this commodity space that's still in a long-term rising channel over the past 30 years, but it's also in the last 10 years still in a downward trend. So this is a big piece for the long term, but you can see by going long Freeport, we own some basic materials, long some bank exposure. We still have a feeling that this was support, and that's when I started buying some of these pieces to the long commodity based side, growth reflation side here a couple of months ago. Obviously the index is not even back up to falling resistance here, but where it breaks out of this blue shaded narrowing pennant pattern, which direction, breakout would be very bullish for commodities. And if we have a breakdown here, it wouldn't be pretty. We'd have a very disinflationary, deflationary theme. So I would think stocks would do poorly if it takes off here. Bonds would do poorly here. Bonds would do well if it would break down. So an update on our positions that we have. So this is I kind of wanted to split it in two. This is I'd mentioned early on that we took some profits and raised some stops. These are some positions that we closed in the last week. You can see that Freeport, we closed it a couple of different parts of it, a couple different times. One of the trade with a 24% gain, and the other part of the trade with a 28% gain. So you can see TMO, the Thermo Fisher, we closed at a tight loss. I can't get around those, but the thing is when we lose money, the key is not that you can't completely avoid that. It's just trying to minimize that so you don't have a bunch to recover from. So this was the example of walked away from some of the small caps, this IWM and biotech this past week. So raise stops and reduce some of the long positions here. And then at the bottom is a look at our current positions. Rick sent an update on that yesterday. Due to a few of you asking for this, we're now sending the positions to premium members twice a week, Tuesdays and either late Thursdays or Fridays, just to keep you updated on the action. So here's our open positions that we have and what the gains or losses as of tonight's close. So we'll go through a few of these, kind of looking back on some of the older ones. This is the oldest position that we have, bought in 2016, last summer, excuse me, at 1. This is just the XLF. We owned it and sold into this rally, and then it backed off. We still own 10% of the holdings, and then right in here, when it backed off, you'll see later on, I just chose to, instead of go back and rebuy more XLF, I went in and bought Citigroup as a replacement to this positive trend that's going on. But as of this week, XLF on a counter trend rally is now at the highest level that it's been in several years, attempting that it could close the week at the highest level in years. Here's where we are at 2. Here's now kind of moving up the line. This is AGG, from some of the oldest to the newer positions. This is the aggregate bond fund, which is a bond fund that has several different types of bonds in it. So its coupon yield is lower than, say, TLT, and its standard deviation is lower. So if you're right on bonds, you'd rather own TLT than AGG. If you're indifference or whatever, or if they're going to go down, you would lose less with AGG. But we were fortunate to buy it here late last year, got off to a good start, then it came back and it looks like a potential double bottom. Then AGG's rallied a few percent higher, did hit falling resistance of late and has backed off and remains just below falling resistance again. So I've left the stop fairly wide on this position. I want to just continue to collect the interest on this, 10% of the portfolio. So we're not big up on a percentage wise, but when you add the capital gain plus the dividend, we made a few decent percent on a really conservative position here. So this is a EFA. We've been trying to share a lot of bullish ascending triangles. We picked up EFA at 1, and then we've harvested some of that position as it's come into potential resistance. You can see this unfilled weekly gap up here. That's where I shared this resistance line several months ago, and we harvested into that. We've seen it back off, and now it's trying to punch through. So we still remain long this position, and if it can get past this level at roughly 69, you could have a rally up to the 73 level fairly quickly. So positive price pattern is facing some older highs right now that have been heavy in the past. That's why I've created some pocket change, harvested part of this position, and also pulled up stops. Here's a look at McKesson that we are actually stopped out of today, but I want to just kind of share with you what we did. We purchased McKesson, got fortunate down in here on the breakout, and then sold shares into resistance. And then you'll see that it's spent almost 2 months up here. So I pulled the stop up fairly tight as of this last week, and we were stopped out of it. So I'm going to continue to keep my eye on McKesson because it still does remain in this long-term uptrend 1. And if it would happen to break out at 4, it could have a nice run from the 165 up to the 200 area. So I'm going to keep this on the radar, but we did reduce some exposure today with an early decline in McKesson that hit our stops. Here's a look at Freeport McMoran. One of our favorite patterns is a bullish falling wedge, and so we're looking that Freeport appeared to be testing dual support at the apex of this bullish falling wedge, picked it up, and then you can see it started pushing, and then last week had a really nice rally. The rally took it up to an unfilled weekly gap here, and that's where you saw earlier I sold twice on the position, and it's backed off some. Right now the trade isn't up quite as much as the two other pieces that we sold, some of the gains. The stop is set fairly tight, so if something would go haywire here, we're still going to net some pretty good gains on the position, but the stop would close us out if it's triggered. If it can break above the 1489, just call it the $15 level, it could run to 16 pretty quickly, which would be what, another 6 or 7% gain. And then if it happened to get above the $16 level, it could run into the low 20s pretty quickly. So still like what we're seeing here, have harvested a little and brought the stops up. But here was a comparison just since kind of going back to the decisions when you see something positive in copper or Freeport. I'm typically going to err or lean to the side of the higher standard deviation. If we're right, we can get more bang for our buck. But this is just an example since Freeport was purchased on May the 19th. You can see that the S&P is up around 4%, and that's not a bad gain whatsoever. But I do desire when we take these positions to try to really outpace the broad market and outpace some of the other choices. So you can see copper is up 12%, much more than the broad market at that time. Then you can see Freeport up 23, so almost a double over copper. So if we continue to be presented with opportunities like this in the future, you've kind of got an idea of why I want to go for the higher standard deviation plays if we're fortunate. Here's a look at Citigroup. I shared earlier that we'd pulled back exposure to XLF, and then when I started seeing some positive action in Citi, we went and instead of buying more of XLF, I preferred the higher standard deviation play, which is Citi, which obviously got crushed from a measly $500 or $600 a share down to 12. Right now it stands around the $70 range, but there was a bullish pattern here as it started breaking out. We picked up Citi, and as sharp as this was, it does lead to some potential for some pretty nice gains. But again, our stop is just below this support here, and I like how Citi is acting. Here's an example of, as I shared, we bought Citi on June the 8th, so had it just short of 2 months. You can see in that time period, the S&P is up 1.7. XLF has done well during that time frame. I liked the pattern of the banks at that time. It would be nothing disappointing to have picked up the 6% gain, which would have been almost a triple over the S&P in that time period. Chose the higher standard deviation play, and you can see that Citi has far outpaced the broad market, and it's the broader perspective of XLF in general. So this is another example of similar to what I did in the thought process with FCX, did the same thing with Citi here. Here's a look at China. We're long the China FXI. Again, the trend was up, bullish, ascending triangle. I thought this looked nice to run up against some old resistance, but come back down to test the top of the triangle, and then this big push higher. The position is so far, rewarding for us. There is a large unfilled gap up here at around the $45 range. So if there's any truth that the gaps will be filled, that gap would come into play a couple of dollars above where we are, or about 5% above current prices. So I've brought the stop also up in this position, and so far it's treating us well. Another one that interests me that we kind of went into the face of some of the Amazon Whole Foods story. This is Kroger, one of the nation's largest grocery store chains. You can see a topping process, some could argue of a head and shoulders top, but regardless, from the start of last year, around the $43 level. You can see Kroger really got hit hard. This is the weekly action, this huge red bar of the week of the announcement that Amazon was buying Whole Foods. So while that was taking place, I noticed that the decline brought Kroger down to the 61% retracement ratio from the financial crisis low to the 2016 high. So to retrace 61% of that. And also it was testing this rising support line, and volume during that week, and excuse this, largest volume since the lows last week, that was a few weeks back, but during that week you could see just how high the volume got. So there's a chance, while this bullish reversal pattern was taking place at dual support, that's where we decided to pick up Kroger, and so we're seeing a little bit of a breakout here. Oftentimes, you know, this big of a move, once it starts trying to move up, it could fill it fairly quick. I'll just, you know, I don't care about the speed of it, but we'll be looking, if we happen to be fortunate, if we could get Kroger up to the $28 level, we'll be looking at harvesting some of that position. Look at coffee. Coffee was bought just a couple of weeks ago, and I liked that we had one of our favorite patterns again, just like Freeport, bullish falling wedge. You can see this really nice reversal that they tried to sell off JO and break below these lows. On a weekly basis, you see a nice bullish reversal, and then it start to push higher, picked up coffee, and so now it's making the attempt to break above the bullish falling wedge resistance. This was last week that I was impressed with, that during the week it tried to sell off coffee. The selling dried up and buyers came back in, pushed it a little higher. This is this week, tried to almost do the same. You see that wick right there. So right now, coffee, JO, is up against what I'd say is some resistance, which was this high, or this low, excuse me, at the start of this year. It's pressed up against that. So if enough buyers can come forward and push above that, we might be fortunate and have a rally up to the $21 level, as a further breakout could attract buyers, and that would be almost another 10% gain. So we'll just have to see, but this is a big test, I think, for JO at this current level around the $19 that we're facing right now. A look at comparing since we bought coffee. This compares the broad market. Coffee's up just short of 9% since the purchase, so you can see a big expansion above the broad market. And then DBC, just as a reminder, is the broad-based commodities index. So this again is a similar play to FCX. That we bought FCX over copper. We bought Citigroup over over the XLF, the financial ETF, and it did the same here as far as the commodities have positive price action, up about 4%. But you can see got over 100% gain above just the general commodities in what coffee has done lately. So these are examples of making some decisions on allocation, and also just believing in the power of the pattern and what it can do for us. So in getting very close to wrapping it up, this would be one of the down and dirty sectors. So on the left, we're going to just discuss retail real shortly, and getting close to wrapping up today's webinar. On the left is the retail ETF XRT divided by SPY. So you can see that there was almost a double top here in 2015, but the bottom line is retail, not telling anybody new on this fact, but retail has been a ton weaker than the broad market for a long time. But there's a chance in this huge sell-off that there's a bullish falling wedge taking place. There's no doubt that in this blue shaded is a falling channel, and we see the ratio testing the top of that channel. So here's the trade on the right. If we were to make one, this is a look at XRT without being a ratio, just XRT itself. You can see it's been lower since 2015. Here was a high in the last 8 months, and then quite a precipitous decline. And now the XRT is testing falling resistance. So don't own it at the time, but it does. It's on my radar screen as far as something that's just gotten pummeled, and might be of interest to us. It would be of interest to me on a breakout. I want to see some strength and a breakout take place but I didn't want you to be surprised on why we'd be buying retail. But here's an update on kind of some things that interest me in this very hard hit sector. So as I said, we were getting close to wrapping it up, and we're there. So I know in time, sector members are going to see this on a delayed basis, but I want to thank each one of you for your continued membership. I hope you're having as much fun as I am from just the power of the pattern analysis, but just also some of the gains that the patterns have been able to bless us with, of late. So again, thank you for your membership. It's really fun working with all of you. I consider many of you friends. Thank you for the referrals that we've received. They're very much appreciated. So I wish you all the best as we wrap up summer and as football season is not too far away. So thanks again, everyone. All the best, and send us some questions if you happen to have any questions. Thank you.